Hey everyone, welcome. I hope you guys had a great day. It was kind of a not so interesting day in the market, but we did get a little tiny bit of a downward movement. And so we'll take a look at how significant it was. Actually, not very significant at all. But on an intraday basis, it did look like downward movement for most of the day because we did sort of do a baby gap up and then a trade down basically all day long. And we can see that over here. So we traded down, and then I guess in the last half of the day, we would just call it chopping sideways. Now, today, well, let's take a look. We'll do a review over the last week of everything that has happened. And so one thing I like to do is that review of the gamma and how well gamma did. So today, for sure, gamma did not do well. It's probably the first time that we've seen, the first example that we've seen of the gamma not being able to predict where that was going to go. And that has a lot to do with options expiration. So if you don't know, especially if it's triple or quadruple witching, but today was not. Today was a normal monthly expiration. But what happens in these options expirations is there's forced rebalancing. There's a lot of order balance, and then it's compounded by the fact if we happen to be in triple or quadruple witching, there's really no such thing as quadruple witching anymore in the United States. Quadruple witching, the fourth thing that had expirations would be individual stock futures, but the United States doesn't have individual stock futures anymore. Those ended, I believe, sometime during COVID time. So quadruple witching, when you hear about people talk about quadruple witching these days, it's really just triple witching. Triple witching is stock index futures, stock index options, and stock options. And then normal monthly expiration would be stock and index options, and instead of no futures. So this time around, it was just stock and index options. But if we had the index futures on top of it, then everything that I'm about to say just multiplies. So we have forced rebalancing because everything expires. All the ETFs, all the indices, all the major funds, they have to go and rebalance their portfolios and rebalance and decide where they're going to put on their new options. A lot of these people are using these options as hedges, remember. So they're not necessarily speculating using these options. So a lot of them have to go in and just put on new hedges, new positions to replace the things that are coming off. So that can create a large amount of order imbalances, a lot of trading volume, big price swings. And then on top of that, you've got the market makers who have to delta hedge themselves. And so as each fund is making these big changes or putting on this new exposure and old exposures falling off, then the market makers got to constantly hedge themselves as well. And gamma is the largest right next to expiration. So the ones that are expiring are super sensitive. And so the market maker is constantly going back and forth, and that creates a lot more volatility, a lot more price swings as well. And tiny swings in price can cause the market maker to hedge even more, and then that creates even more volatility. Market makers then, because of all of this, they don't necessarily have a good handle of where everything's going to go, and then they'll widen out their bid-ask spread. That starts to kill liquidity, and then you have some gappy type of movements, and then that can also trigger algos. It can trigger bots because they're trying to trade momentum, and then you add their noise on top of it. So options expiration, major options, like monthly options expiration, quarterly options expiration, and the triple witching, those are all days where everything just swings wildly back and forth, and therefore a morning gamma picture is going to be a lot less accurate than what we normally expect. And we saw that today. So if I look at what I sent out today, how do I, Okay, here we go. I'm gonna get rid of this. Oh, there we go. Okay. So today, I said, okay, in the morning, we're looking at 630 gamma exposure, but the market disagrees with it. So, and then look, today is expiration. We're going to see a lot of volatility. And basically, you don't want to rely on these numbers on this particular day because of all the reasons that I just talked about. And all the way until about half an hour before the market closed, that 630 on the S&P 500 was sticky until finally, in the last 20 minutes or so, we finally got this shift down to 628 was what literally right before the market closed, 628. This is surprising me because I didn't see the shift happen. It went to 627, but literally right before the market closed, it said 628. I think we closed near 628. Let me just verify that. Right in between those two. So we don't want to rely on gamma necessarily on days where we're seeing all of this rebalancing going on. So Friday, gamma did not do us any good. Okay, let's take a look at Thursday. Just remind ourselves, I think we pinned it exactly. So concentrated around 628, but there was a step up to 628. So yesterday we pinned it at 627.99, I believe it was. Yeah, 627. It says 628.04. Okay, still within a few pennies. Gamma nailed it, and then Wednesday. What is this? 6240, we went to SPX because SPY was not giving me any sort of gamma picture whatsoever. So Wednesday SPX, we closed at 6263. Okay, so not super close, but if I divide everything by 10 to get it closer to S&P levels and then adjust a little bit, then it was reasonably close. I wouldn't say that it was super close, but it was reasonably close. And then on Tuesday, said choppy between 620 and 625. And then I said that we would bounce. Like that was the day that Trump said, oh no, I'm not going to fire Powell. And then we ended, is that the same day? I need Tuesday. Where's Tuesday? Tuesday, chop. Yeah, I said there's chop. There's no clear levels right there. And then, did we get chop on Tuesday? I think we did. This Tuesday, Thursday, Tuesday. We're actually a little bit more of a downward directional move, closing at 622. Let's see what we said. I'm completely lost on my dates now. 15th. Here we go. 623 to the downside. So, that was when the very last second we were at 623, and then the very last 3 minutes we went down to 622. Okay. And then on Monday, we went 625, and we closed at basically 625, very close to it, I believe. Okay, so gamma mixed bag this week. Mixed bag. I was like reasonably good, but not like super great. Especially today. Today was just a complete miss. Okay, so remember that gamma is just a tool. It gives us a very likely idea of where everyone's exposures are and where they're positioning themselves, but it is not a perfect tool. It's not going to be right 100% of the time. Nothing in the markets is going to be right 100% of the time. But if we know how to use the tool, we know when to use the tool, when not to use the tool, then it can become super useful. Like I said today, hey, It's probably not going to be as useful because of the options expiration. And then on Wednesday, when I switched to SPX, I'm like, SPY is not actually telling us anything useful. SPX might give us a little bit better of a picture. So we need to know when to adjust and when to actually listen to the market and market price action rather than what is going on in gamma exposure. So just be aware that even sometimes like gamma is amazing. Like yesterday when it pinned right on the dot, it was pretty amazing. And most days it does a really good job. Just know that it's not every single time. Okay, let's see who's in here and say hi because I've been talking for a while and it's more than enough time for the delay. Hey Tim, hey Spider Monkey, Peter, John. When you're in a trade and it's going against you, what percentage do you close it out? Okay, that's an interesting question. And ADJDLR, good to see you. Unless you're also JDLR, in which case still good to see you. And let's see. So what percentage do I close it out? I don't close it out based on percentages. I close things out based on the trading plan. Okay, so good thing we already started about talking about a trading plan. We'll continue to talk about the trading plan. But generally, I'll just give you the quick version and then we can talk about it when we talk about the trading plan. The quick version is I based it on whether or not it's random price movement. Because I don't, one thing that I want to emphasize and that you'll hear me say over and over again is I don't want to lose money due to randomness. I want to lose money because I was wrong. Right? So I don't care. I don't mind being wrong. I know I'm going to be wrong. I just got through this whole thing saying that nothing is 100%. I'm going to be wrong sometimes. I'm going to be wrong a certain percentage of the time. And I know that. And I don't mind it at all. Yeah. But if I lose money, I don't want it to be because of something stupid. I don't want it to be because of something random. I want it to be because I was just wrong. And if I'm wrong, then I should lose money. That's the way that works. And if I lose money, then it should be a non-significant portion of money. And it should be an acceptable amount of money to my portfolio. And then that's it. We'll just move on after that. Okay, we took a hit and move on to the next trade and make up for it. So that's why I can't say what percentage that I lose out on, or what percentage that say, oh, I'm just going to exit, because I don't know if that percentage represents randomness. So for example, let's take a look at what we're on right now. That's the ATR is 4.89. The ATR being 4.89 means that in the last 10 days, the average 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right here, basically ever since we started chopping, the average over here has been a roughly 4-point swing up and down. Okay, so if this 4-point swing, what does that represent to me? I guess 4.89. 4.89 divided by the current level where we close at 627.58, that's a 0.7%. That's not a very large amount. So a 1% movement downward already tells me I'm probably looking at a non-random movement. So what is a non-random movement? If I go from here down to where we closed, another 1%, okay? That's already non-random for Monday. And then you go, well, okay, where does that actually, that is a lot of lows were right here in the past couple weeks. So there should be at least a little bit of support there. And then I go, okay, well, I like the EMA 20 as support, great. Then I gotta be prepared for 1.5% down. Again, non-random movement. But let's find something with a really high ATR. Let me see. I have a list. I don't have a list. Let me see. Let me do a real quick search. Let's see, maybe ARC. That doesn't look, okay, let me do a calculation. Stock fetcher. So if I look for set ATR ratio to be ATR 10 divided by close. Okay, and then let's do ATR ratio is greater than 0.03. Add column ATR ratio. What the heck? Entry, that should be impossible. So we probably have some bad data right here. Okay, so these are penny stocks. Penny stocks are probably good examples. So look at this. Okay, if I go let's not do such an extreme example. Let's say in the S&P 500. Market is SP 500. Okay, so if I do Molina Healthcare, okay, that's a big move downward today. Okay, so this would be this is like a downtrend. This is a big movement today. So from yesterday to today, it moved 21.27. So that's almost 2 ATRs. That's definitely not random movement. But the day before, it went down only 11. Okay, 11.8. So that was less than 1 ATR. And then the day before that, it went up only 1.45 when the ATR was 12. So this is random movement, random movement, random movement, random movement, random movement. Random movement still, even though it was a larger movement, and then definitely not random movement right here. So if for whatever reason I was long this stock, I wouldn't be because it was kind of like a short. Then we would say, hey, this non-random movement is what told me that I was completely wrong about this. So let's spin it the other way. Let's say I was short Molina Healthcare. Normal movement, normal movement, normal movement, normal movement, normal movement. Big movement, but still normal movement. Extreme movement. Oh, what does extreme movement signal to me? It could signal to me that it's time for me to exit. Or, and then put on some runners, okay? Because it could keep on going. But I should be starting to protect my profit right here, because when things go extreme, that's when things tend to end. This is parabolically downwards. So parabolic movements tend to get either go flat or revert, okay? So that if I'm wrong, I want to be wrong because I'm just wrong, not because of randomness. Let's see if I can find a better, NEM. There we go, yeah, NEM. On this day, okay, my ATR is 1.5. And this looks great. Looks like we bounced off to the EMA 20 and we're starting to head higher. Okay, so this fit my criteria of 50-day moving average moving upwards. Then on the shorter term, the EMA 8 did this. Great, beautiful. So we got a buy signal over here, and then we had enjoyed 2 days of upward movement. And then what happened? Bam. Downward movement by 3.47 points. That's almost 2.5 ATRs right there. Non-random. I don't mind being wrong and stopping out of this because something changed. And that what changed was news. We talked about this on the show a few days ago or last week, where the news happened and it shocked the ticker, the symbol, the local market, the NEM market. And then we got this extreme move, non-random move downwards. And then what did I say to you guys? Oh, look at where the support was. It's going to bounce back up. And the news is probably only going to last just a few days. So there were certain conditions that I said it's okay to go back into NEM because I did not expect this to last. Okay, and those conditions were we start to curl back up, et cetera, et cetera. But this is non-random movement, and so getting stopped out by this is great. But what about this one right here? What about this one? This one was a 2.55 drop on an ATR that was $1.71. Okay, so this is also non-random. So this, even though it ended up bouncing, this was a good stop out as well. Although I probably would have put my stop below that EMA 20, just below that EMA 20. So probably wouldn't have gotten stopped out, but this for sure would have gotten stopped out. Okay, so you don't care if we're wrong because there's no way that we could have known that news before it happened. And so something did fundamentally change. An assumption that we had when we went into, we'll talk about all of this when we get to the trading plan. Assumption that we had when we went into the trade got violated. And that's an excellent reason to close out your position. And then my thesis, new thesis though, if I was still interested in NEM, was everything that I told you guys about last week, which I said, okay, well, my thesis is that news wears off within a few days if it's not an extreme fundamental shift in the business and the business trajectory. And it was just a replacement of a CFO. So I said, okay, well, here's my new trade idea. My new trade idea is that the news is going to wear out and the old trend is going to reestablish itself. And so my timing is going to be when the EMA 8 and or EMA 20 curl back up and my price is above them. So when I see all those three things, those are my signal to be all in. And I did say, okay, well, we can phase into it. So EMA 8 up first, then EMA 8, EMA 20. And then if I get a pullback to the EMA 8, that would be my third entry. So that was my criteria. So that's the beginning of my entry plan. That's my timing. That's my timing. And then when I see that happen, then we can talk about execution. And has it happened yet? As of yesterday, it hadn't. But you can see, I was right about it starting to come back up. Okay? But my plan says, gotta wait till the short term curls back up. Why? Because it could just do exactly what it's doing right now. And just chop sideways and just chop at the EMA 20. We're not ready for entry yet. So my very first criteria for the first phase of entry was EMA 8 curl back up. We haven't gotten that yet. So we were right about it bouncing and starting to resume its, we're right about bouncing. We're not yet right about it resuming its trend. So the criteria for entry has not happened yet. This curling back up has not happened yet. And it looks like it could happen, but then we got earnings right on top of that. So we got to worry about that as well. So hopefully this one illustrates you what a good what a good exit is. So what is that? What does that represent? What percentage is that? It's going to be different based on my setup and based on my trade idea every single time. What percentage? Now, it is still a very good question because, oops, what happened there? Do I still have you guys? Did I lose you? I don't know what happened there. Maybe I never had you. Not sure what happened. I think you guys are still here. Made that mistake a few times and regretted it. I stopped out of it, then entered the next day, going to try to make my money back. Have to learn more patience. Yeah, okay. Yeah, Tim, are you talking about NEM or a different one? So, where were we? We were at, the question is still really good because we want to be aware because we're throwing options on top of this. So when we're throwing options on top of this, okay, so if I lose 90% or 10%, okay, let's just okay. So if I have a consistent trade size, if I say I put $1,000 into every single trade, or as close to $1,000 as I can, okay. So if I put in $1,000 and then I end up losing 10%, then I'm left with $900. Okay. So the question is, at what point, how much do I have to do in order to recover? Okay, so if I go, I should -1. Probably easier to think of it that way. Okay. So basically, if I take a 10% loser, then it only takes a 11% winner to recover. Okay. And sorry, this is not what I said. This is not putting $1,000 into each. This is your account value. Okay. So if my portfolio loses 10%, so I don't have any additional money to throw at this. If my portfolio loses 10%, it then has to make 11% to get back to break even. And what we see is that this difference in how much it has to recover in order to get back to break even gets really extreme really fast. Okay, so if I lose 20% on my portfolio, I've got to recover 25%. If I lose 25%, I've got to recover 33%, et cetera, 50%. I've got to recover 100%. I've got to double my account now. And then if I let it go down to 30%, I'm talking about 233%. And then if I lose 90% of the value, I've got to recover. I got a 9x. I've got to have an incredible performance. So this is why we don't want to over allocate. And if we can, it's much easier to just take a consistent trade size and then every once in a while change that trade size. Because if I can do it that way, then a 10% loser, then I just have to make 10% on the next one. If I lose 25%, then I just have to make 25% in order to make up for that loss. And if I have better than 1-to-1 reward risk ratios, then that should be relatively easy. But if I allow this to happen on my portfolio level, then I can't put in. If I lose $100 here, I don't have another $100 to pull from my pile of cash in order to put into $1,000 into the next trade. So I have to use my entire portfolio available, that $900, and I've got to perform at 11%. Not that bad, not too bad, okay? On an options trade, 20, 30, 40%, those are all pretty common. Those are all pretty, like, not too hard to achieve. So in this case, I want to be aware of my portfolio and say, hey, you know what? At about 30%, that's probably about my limit, so that I might want to cut myself off if my portfolio drops down to 30%. So I want to be very aware of that. So basically what I need to do is I've got to allocate in a way. It was like, what's the possibility, or what are the probabilities that I'm going to lose once? It's probably pretty high. Even if you're a trader who wins 70% of the time, you're going to experience loss 30% of the time. That's a reasonably high number. But what about 2 in a row, 3 in a row, 4 in a row, 5 in a row, 6 in a row, 10 in a row? 10 in a row, if you're doing your job correctly, unless you're just one of those ones that's just swinging the bat and looking for home runs, then your win rate should be presumably above 50%. So 10 in a row should be fairly difficult. But how likely is it that you'll hit 2, 3, 4, 5 in a row? There's a lot of ways to this is way too deep for me to just go on a live stream, on a post-market live stream. But so if you want details on exactly how to do this, I do teach this in my programs. It's going to take me way too long to explain this. But basically, if you can get a good feel of how many in a row you might lose, maybe just say it's 4. I want those 4 losers to represent less than 30% of my portfolio, because I can still recoverably reasonably easily if that happens. Okay, so just be aware of that. So your question about how much do you cut off percentage losers applies better to a portfolio level than it does to a trade level. Right, so I just wanted to make that point right there. Okay, so on a trade level, all I care about is, was I wrong beyond randomness? Okay, if I say tomorrow is going to be sunny and it snows or there's a blizzard, then I was completely wrong. Okay, then call me wrong, I don't mind. But if I say tomorrow is going to be sunny and 80 degrees outside, and it ends up being sunny and 75 degrees outside, and everyone in the world is telling me I'm wrong, I'm gonna be like, nah, I wasn't that wrong. Come on. I'm still dressing the exact same way. I'm still I'm still preparing for my day the exact same way. It's not wrong to the point where any of my actions were really affected me. And we want that to be the same case on our trades. Okay. I was on the whole time. Great. Thank you. Okay. So hopefully that clarifies that question. And we'll utilize some of those principles when we go back to talking about the trading plan. All right. So SPY, basically this picture hasn't changed. I don't have to spend too much time on it. It's just chopping sideways above this EMA 8. However, could you call this a bounce off of the EMA 8? Maybe. And that flies in the face of this idea that we're going to have a pullback. That's what we were talking about yesterday. So just because I have that view doesn't mean I'm trading it. I'm trading what I see right now. What I see right now is a market that went up and went sideways and maybe bounced off of that EMA 8, which means I should still be bullish in my portfolio, in my actual positions, which I am. If you look at any of my services, we've only been putting on bullish positions. But I need to be cautious. I'm not aggressively putting on new trades. I'm not aggressively putting on things that I think are going to be big winners. When I see my profits, I'm taking them fairly quickly, because I don't know if we're just going to chop right back or even go against us. So this is not a super strong trending market where I can just put on a position and just let it ride. Okay, I'm going to take my profits really quickly. That's what the whole point of the afternoon session for is, like, what type of environment am I trading under, and what should I, what types of strategies should I adopt And that's what this is telling me right now. Now, yesterday, we also took a look at gamma across the next 2 weeks. And we saw that gamma was suggesting that we have room to go up, maybe up to 630. And then after that, we'll see. Maybe that's when we finally get our pullback. So again, we should just be mildly bullish right now, but prepared to step on the brakes. So we went through where we saw sectors, and I'm just going to run through and do a real quick examination of what the sectors did today and if there's any significant changes. Okay, so I'm going to do sectors, sector. Okay, so it looks like XLU and agriculture. So I'm going to look at these ones that moved more extremely, so close to 1%. I'll look at mags as well. And then anything that moved down significantly also. SPY is basically flat. So it looks like small caps, that's interesting. Healthcare, small caps, energy, biotech. Okay, so everything's chopping because biotech led the other day. So let's look at XBI. Yeah, nothing too interesting there. Hit resistance, starting to chop sideways. Home builders, very similar looking. Energy, very similar looking. IWM, a bullish breakout right here with the uptrend, but hitting some resistance, horizontal resistance right here. We'll have to see if the broader market pulls back, then we could be back in trouble territory with the small caps. And then healthcare, yeah, healthcare was one of the worst sectors that we looked at. Yeah, it's still looking terrible. Okay, so let's look at MAGS, XLY, DBA, XLU. MAGS strong. I actually made a new high today. Not a all-time high, but it did move higher than yesterday. So MAGS definitely a little bit stronger than SPY today. So large cap stocks. So supporting this idea that I should just be super mildly bullish right now. And then we had XLY. Yeah, very mildly so. Very mildly so. Didn't just hit these highs right here. This is really just a slightly wider range chop. DBA. DBA definitely not ready yet. And then XLU. Okay, so XLU is interesting. So we drew these lines, I think, last week, and we said if we started to see a breakout, then XLU could be really interesting. And then we compared it to XLU SPY. XLU SPY is still not ready yet, but in a shorter term perspective, or from a dollar perspective, it's looking like it did break out today and go above this high. So what we'll want to see is, does this keep running? Because this is kind of an extreme move. It does look parabolic on a small scale. Then maybe it goes up higher for a couple days. Maybe it starts going sideways for a couple days. Then does it pull back and retest this region? And if it retests and bounces, then we're probably good to go. If it retests and breaks, then we're right back into the chop. So this is something that we would watch carefully. We would not take any action yet, but it deserves to be on a watch list to see whether or not it starts to run upwards. Okay, so for the most part, nothing different from yesterday. ITA probably still looks good. Yes, XLI still looks good. Yeah. So there's a possibility of adding XLU back into one of the sectors that we would be interested in if the market does pull back. Okay. the market in a slow period and the market as a whole looking for a pullback soon, more caution. Yeah, just cautiously bullish, small bullish positions. That's what I would be putting myself in, and I'll be taking profits, because if we're just chopping, the overall market is just chopping, then like constantly going today up a little, today down a little, today up a little, today down a little, today up a little, today kind of started up higher, then went lower. So in those conditions, if I get something that moves in my favor and makes a decent profit, then I'm going to take that profit. I'm going to take the profit and just go. I'm not going to try to ride out really long trends at this particular moment in time. It could work out for individual stocks like Hood. Okay, so in this time period, we could have rode that out. But look at that. You see that how it went a lot higher right here, and especially since we have a doji right here, great time to take profit, because it could just pull right back and then go higher. Right? It's not just going to trend just straight up every single day. Although, I mean, it's kind of close to doing that. But we don't expect your average stock. But if something is super outperforming, it could do it. But most of your stocks are not going to see that pattern. Okay. XLU was entered as, oh, it was XLY SPY? XLU SPY, thank you. Yeah, XLU SPY is still not ready from a SPY. What this is telling me is that the SPY is still stronger than XLU. So XLU doesn't have relative strength to the SPY yet. It looks good by itself, but SPY is still outperforming it. And unless this keeps on moving upwards aggressively and SPY keeps going sideways aggressively, then that could change. Then XLU will begin to start outperforming SPY, but it hasn't happened yet. Okay, so if the SPY is going to continue to move higher and XLU is going to continue to move higher, at this moment in time, I'd rather be in SPY because SPY is stronger. Okay, so if they both go up, I'd rather be in SPY. If SPY goes sideways and then XLU surpasses it, becomes stronger, then I'd rather be in XLU. We haven't reached that point yet. Or if SPY pulls back and XLU continues to move upwards, then it has a lot of relative strength to SPY, then I definitely want to be in XLU. But again, that hasn't happened yet. I'm just preparing and saying it could happen. There's an increasing probability that it could happen, and so therefore I want to pay attention. Okay. But thank you for that, Bernadette. Even though it was late and I probably saw it way later. Then, okay. So let's go back and start talking about that trading plan again. So what we talked about already, I'm going to have to retype it because I think I got rid of that screen, is that 4 pieces of a good trade. That was the trade idea, the trade timing, then the execution, and then the management. Okay, and all of these things are going to dictate our trade. So let's see if we can do a plan in the next 15 minutes. So do you guys, is there anything that you guys like right now? What's a trade that you're looking at that you'd like to go into? Tim says quantum computing. Okay, let's see. Quantum computing ETF. QTUM. Hood. Okay, Hood is a tad bit overdone. We would have to wait a little bit, but we could use Hood. Oracle, RQQ, ARQ. Actually, both of those have shown up on my list. So Oracle, ARQQ. So you could be very right about this quantum computing thing. RGTI and HPE, AMD, and I'll stop right there. Maybe QUBT, TSEM, HEP, what is it? TSEM, AMD, QUBT, and Core. I'll stop right there. Okay, Microsoft. Let's take a look at, okay. So when we come up with our trade idea, it could be based on technicals. It could be based on a system. It could be based on news or momentum. It could be based on anything that we want it to be. But so we can, what does IonQ do? So what I'm going to do is I'm going to do a blend, right? So we have so what is our thesis here? Probably the quantum is going to be easier to show you on blending of everything. Because if we're doing hood, you're probably mostly basing that on technicals. You could argue that sort of it's part of this crypto thing, but hood isn't really directly related to crypto, not the same way Coinbase is, right? So they're both, actually hood's not even an exchange. Coinbase at the very least is an exchange. Hood is just a broker. So we can't really argue that they're really deep and really super related to crypto. So hood is just kind of doing its own thing. Microsoft, we could argue that is this kind of AI related, but again, not necessarily super directly related. They're not a leader in AI for sure, or at least they're not calling themselves that, and they're not showing up in the news as that. So QUBT is quantum computing. I don't know what IonQ does. What does IonQ do? Quantum. Okay. What I'm noticing though, QUBT and IonQ look very, very similar. Right? AMD, clearly different than those two and stronger. TSEM, clearly different. HEP, that's definitely not the one that we're talking about. So I'm just going to strike that off the list because I can't seem to get the right ticker. RGTI. Looks like IonQ and QUBT, except accelerated by a couple days. Like this is looking like what IonQ and QUBT could become in a few days. Okay, and then COHR, nice trend right there. ARQQ. Okay, ARQQ looks just like IonQ and QUBT and Oracle. Nice, beautiful trend right there. Okay, so what was it QUBT? That was the ETF? Which one was the ETF? No, that's a stock. Quantum QTUM. So if I look at QTUM, also very nice, beautiful trend in the ETF. So let's come up with a thesis. Okay, quantum computing, there's a lot of money going into quantum computing. It's going to take advantage of AI. The two are feeding off of each other. So a lot of companies that are involved in AI, they're also going to be looking into quantum computing to increase the speed and efficiency of their AI, blah, 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 blah. There's a lot of interest in quantum computing. That's a reason for me to look And then I come and I look at this technically and I say, wow, that's a really good trend right there in that overall sector. So now I'm even more interested because the likelihood of the timing being right is pretty good right now. Okay. So that all of this is still going into my trade idea. Now I say, okay, well, do I want to just have general exposure on to the ETF, to the sector, or do I want to look for stocks that are going to outperform that sector? And if so, then which ones are interesting from that point of view? So if I look at this and I say, look at this, and then if I go I on Q, okay, it had its day right here and it's just been chopping right here. Some people will call that a cup and handle. I hate chart patterns, so I don't care. I don't care what it, all I care is that we have this resistance right here and we're touching it and we could break out, okay? So do I want to break out or do I want a pullback play? Breakout is higher reward risk ratio usually because look at this type of candle, but lower probability because this could fail. It could fail. It doesn't have to fail, it could fail. But when my sector is trending very nicely and my S&P 500 environment tells me that I should just only be very mildly bullish, and that my volatility regime tells me that I'm in a buy the dip or buy the pullback type of regime, then when my ETF looks like this, that looks like a great buy the dip environment. But this stock is looking more like a breakout environment. So that automatically puts it lower on my list. Did amazing, and then it did nothing. Whereas the ETF just went straight up right through all of this. So if I look on a relative strength basis, I on Q is most likely going to not look so great versus its ETF. I on Q divided by QTUM. Okay, and we were right. So I on Q did great on that giant spike, but then it was very flat ever since then. Okay. So let's take a look at that other one, QUBT divided by I on Q. Not I on Q, QTUM. Okay, again, it did great, and then it just chopped sideways and kind of did nothing. Doesn't mean if they break out, then yeah, they could outperform again very temporarily and then flatten out again. Sort of like that RGTI, okay, RGTI. Okay, did great, flattened out, made this sort of cup and handle type of shape like we're seeing in the other one, but really it's just this breakout right there. And if we're talking about what I like to talk about, okay, what is way, 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 way more important to me is that this was the long-term trend, and then this was the reversion, okay, to match. And so the question is, what if it caught this big, massive breakout? So let's do a review, replay. Okay, and I need to delete this so I can see better. The answer is maybe not, because this looks pretty flat, okay? So we wouldn't have noticed it until the next day. And if you're watching intraday, then you could have caught that right at the open. It would have already been an upward slope, so you could have entered very close to the open or whenever you saw it. But right now, even today, it is still kind of, it's too far from its moving average, right? We want it to pull back before we would enter RGTI. So our question then is I on Q and QBT, are those candidates for this type of movement upwards? Is RGTI signaling the future of those two? And it's possible, but in the regime that we're in right now, I would rather be in a mean reversion, okay? it has a higher probability, especially in the environment that we're in. So me personally, I would remove QUBT, I would remove IonQ from that list. Then I'm looking at Core, AMD, TSEM, RGTI gets removed also, ARQQ. ARQQ actually looks more like the IonQ, right? This kind of movement where we hit this horizontal. Okay, the difference here is, nope, never mind. Okay, so I'm taking ARQQ off of that. And ORCL. Okay. So here, that's my thesis. This is my trade idea. A lot of interest in quantum computing right now. More and more money is going to move into it because of AI. AI interest is going to eat up the quantum stuff. They're going to need the quantum stuff, and so there's going to be a lot more interest. Bam, thesis. Timing. Timing, I take a look at the S&P 500. We're still bullish. So there's likely going to be continued research, continued funding into in quantum computing, continued interest in quantum computing, continued excess funds that can go towards research in quantum computing. The quantum computing sector itself is also in a very beautiful uptrend that's indicating to me that Wall Street does have interest in this sector, that there is at least some signs of money moving into it. If I look at QTUM versus SPY, looks good. I mean, mostly flat over here, but starting to move up again. So yeah, timing looks good. How about tomorrow? Do I want to go in? Now I have to fine tune my timing a little bit from, hey, this definitely I need to watch for entries, to, hey, is it ready to enter yet? So my candidates are COHR, AMD, TSEM, and Oracle. And based on a quick look at all of these, the answer is no. Okay, our opportunity was a few days ago on Oracle. I was in Oracle actually until yesterday. TSEM, okay, again this looked a lot more like IonQ, except on a baby basis, right? So TSEM had its move upward. I'm going to take TSEM off. AMD. AMD actually kind of looks similar too. It just doesn't have a huge bar. It just it has gap up instead of that huge bar. So I'm actually going to take AMD off as well. Okay, and this is, so COHR and Oracle are moving much more smoothly. Much less gappy, much less crazy jumps. And so you could have disagreed with me, and you could have said, Kane, I like those giant jumps. I like those breakouts. I am looking for a quick hit. Okay, great. Then we would branch here and we would create two different trading plans. So I'm focusing on just this window. Okay, so because I'm focusing on this particular plan and this type of pattern and this type of movement, then my only candidates right now are Oracle and COHR, or perhaps even the sector itself. So I'm going to take a look at Oracle slash QTUM. Okay, Oracle is outperforming. COHR divided by QTUM. Also outperforming, and just not, yeah, that maybe not the greatest sign right there. We would definitely be interested if it broke over that SP 500, or not the MA 200. But this is clearly above it. Okay, so Oracle is my best bet, or I could just go into QTUM itself. So I don't know which one yet. I won't know until it comes to execution. So let's pretend it was 2 days ago. So if I go replay right here, that is what QTUM looks like. This looks like flat movement, flat sideways movement, only just barely seeing a little curve on that EMA 8. It'd be hard for me to justify to go into QTM on this day. I would want stronger confirmation, a nice green bar breaking above this high, a more clearly defined EMA 8 curling upwards. So the next day I definitely would have gotten it. Okay, so that's yesterday. So yesterday probably was a good entry for QTUM, and let's take a look at Oracle. Okay, Oracle, could I have potentially gone into it 2 days ago? This looks way better right here. Okay, this looks way better. This was on Wednesday. Let's talk about Thursday. It looks even better. I would have gone into Oracle on Thursday, no problem. Okay, so let's just say we're talking about Oracle. It's the stronger of the two anyways. Now I have to decide. I've decided that Thursday was the day, or Wednesday was the day to enter Oracle. So just pretend it's Wednesday. I see this happening. We already developed this idea at the beginning of the week. And then I say the timing is now. Let's execute. Okay, so I have to decide how I'm going to execute. So am I going to do a vertical spread? Am I going to do a butterfly? Am I going to do a simple call? There's a lot of different, am I going to do a call ratio? A callback ratio? What is it? Am I just going to buy the stock? Okay, these are all different ways that I can execute on a bullish view on Oracle. If you want a good summary, I like Option Strat. They have a good summary of all the things that you can do. There's more than this, but honestly, the ones that are not on this list, even many of the ones that are on this list, you'll probably never use. But they also have an optimize feature, which is kind of cool. And I say, I'll go Oracle, and I say, hey, I'm bullish on it, or I'm very bullish on it. Okay, and they'll say, okay, well, you could do a long, a covered call, a cash secured put, a short put, a bull call spread, a bull put spread. These are all different ways. I guess they don't have the callback ratio or any of that, but these are different ways that you could express it. So you got to think about, how am I going to express that view? So some of you are just, well, I only know simple calls and puts, or my account only allows simple calls and puts. So I'm not even going to consider the rest of it because my accounts don't allow it. And yes, you can do it that way. I would say that's very unfortunate if you do it that way, because you're allowing your broker situation or your level of education to dictate what you do, which is rarely going to be the optimal. Okay, sometimes it will be. It's sort of like saying when you're a hammer, everything looks like a nail, right? I have to do a long call. I have to do a long call. It doesn't matter what the situation is. If I'm bullish, I have to do a long call. You're a hammer, and the only thing you see are nails everywhere. But unfortunately, it may not be ideal for you to execute using a long call. Why? Well, if we think about the environment that we're in, and my trade idea, my entire thesis is predicated on the fact that I started at the very beginning with SPY and saying that we are in an environment where SPY is chopping. We have some risk of pulling back, although we should just be very baby bullish at this moment. Is a long call baby bullish? The answer is no. A long call is fairly aggressively bullish. Let's see what do they say anything here? I guess not. I thought there was. In any case, a long call is not mildly bullish in most cases, unless you are going really far in the money. We would never call a long call. For sure, a long call at the money is not mildly bullish because it has to overcome the option premium that you pay for in the time frame, in the expiration period that you buy in order for you to begin to make money. And so your daily growth versus your theta decay becomes very, very important, and you may not get it because if you get something like that moves very steadily upwards, great. If you went for that breakout and it just spikes up, beautiful. But most stocks don't do that, right? Most stocks go up, go sideways, go up, go down, go up, go down, go up. Okay, that's the normal pattern of most stocks. So in those instances, your long call is going to time decay, 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 and then maybe it starts over time. So basically, on average, the price movement upwards has to be enough to overcome the daily time decay. Okay, and that's why you need that strong trend. That's why you're looking for that strong trend or massive breakout, and then you take your profits immediately because what happens after a breakout, it chops sideways or it pulls back, usually, most of the time. Okay, just like RGTI, that was in the same sector. I need to remove the replay. Okay, floated upwards, kept on going upwards. SMR? No, not SMR. Something that we saw. QUBT. Yeah. Spike upwards, down, 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 down. If you didn't take your profits here, not only are you losing on the profits because of the price movement downwards, but also the time decay. Okay, spike upwards, another day moving up, down, 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 down. When we have that parabolic move, the tendency is to either chop sideways or pull back. SPY, okay, not a parabolic move, but strong move upwards, sideways, 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 okay? Gap up, a little bit move higher, pull back, pull back, pull back, sideways, 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 okay? So we want to be aware of that. So if you are in this oracle, expecting for you gotta if it spikes up, you gotta take that profit. If it breaks out, if you were on that ion Q hoping for that breakout, if it breaks out, you gotta take that profit. Otherwise, time decay is going to work against you, and your simple call isn't going to be able to protect you against that. So its best moment was on that breakout. And so in this case, for me, given the environment that we're in, the fact that SPY is trading sideways, it is still overall in a bullish trend, but we're just very, very, very baby bullish on it, and there's that risk of that pullback. I would not be buying a simple call in this. Personally, I would probably be doing either a butterfly or a debit spread. Okay, why? Because I can say, well, if the S&P pulls back 3 to 5%, okay, what is my beta on Oracle? I'm going overtime. So I'll finish up this real fast, and then I'll let you guys go start your weekend. Okay. Let's see. Beta. Where's my beta? 6-month beta, 1.39. Okay. So on average, over the last 6 months, when the S&P moved up 1%, Oracle moved up 1.4%, and vice versa. When S&P went down 1%, Oracle went down 1.4%. So I can say SPY, if we move down 5%, okay, I can expect Oracle to move down 7%. So if we just go down immediately, 7%, look at that. It doesn't even take me to the EMA 20. Beautiful. Beautiful. That's great. It gives me plenty of room. It doesn't break my trend. That is a great, great, great sign. But if I buy a simple call, I'm going to lose money. I'm going to lose probably good, depending on the strike and the expiration, the delta and the expiration. I could lose a lot of money, or I can just lose a little bit of money. Just depends which one that I pick. But what I can do is I can do a vertical. I can do this right there, maybe right here. That's probably way too far. So I could do a vertical right there at 225. Okay, so these are probably 5 wide. So I could set my sell leg right here and then do my buy leg at 220. And then even if it falls that 7%, I'm still in my maximum profit zone. And then a few weeks later, if it bounces or whatever, I don't care. If by the time my expiration dates come by, we're still above this thing, I'm going to make my money. And so it would have been more lucrative 2 days ago, but let's take a look at what a 225 Oracle trade would have been of Oracle vertical. Just say I went, I don't know, 2 weeks, 3 weeks out. On a vertical, I want less expiration because I make money on time decay. And so I would just say 2 weeks out. If I did a 220, 225, or maybe I'll give myself more time because that is kind of deep in the money. So if I do they don't even have 220, 220. They have 220, 230. So if I buy this vertical, okay, and I did it 2 days ago. So let's just say I could have gotten it for, say, $7 or $7.50. Okay. So if I could get it for $7.50 2 days ago, then my maximum gain is $2.50. My maximum loss is $7.50. I can make 33%. And that's not a bad result in this environment that we're in right now, where I either want a lot of protection or I want to take my profits very quickly. And to be able to say, hey, okay, 30%, that's not bad. That's not bad at all. Okay, so that's execution. So we've gotten up to the point of execution right now. Okay, let's answer your questions and then we'll wrap this up. Can I put the symbol in the chat? Oracle? Sure. ORCL. John, you have a great weekend too. And is the optimized feature on option strat only available on the paid account? No, it's there. It's there. Okay. And John, all right, have a great weekend, everyone. We'll end it right there. We'll continue talking about trading plans next week. Have a wonderful weekend, and I will see you guys later.